In this video, I sit down with Molly Nadeau from Neighborhood Loans to talk about reverse mortgages, and we talk about mortgages in general. Kind of what you need to know, the pros and cons, and how to make the best decision based on your situation. Now, since 2000, Molly has built a team of home loan experts who are all about integrity, passion, and just keeping the process fun. They're not your average mortgage lender, and this conversation proves it. We'll cover a few different topics in the video, so feel free to look through the caption timestamps down below to find a specific topic that you may be interested in learning more about. Our contact information is also below in the description. So without further ado, here's our conversation. So Molly, I have a number of clients, I should say prospects, because they haven't really bought with me yet, but I've met them. Yet. I've bought or I've met them at an open house. Usually it's single level detached townhomes, and we talk about what they're looking for. Normally it's no stairs, and all living facilities on one level, meaning laundry, bedrooms, kitchen, everything. And then we get into discussing their current home, and that's where I think they feel kind of trapped. Almost like, I'm going to sell for this much, and then I'm going to end up buying for this much. And I've got a great interest rate. So how can I do this? And make a move. I mean, I know, and so what do you think?
Well, I know we'll be leading into reverse mortgage, but before I go there, this is such a common quandary. I feel like there's a couple of things that prevent people from making a decision to move to the home that would meet their needs. And usually it's rates and stuff. Rates and stuff. Would you agree?
Yep.
Okay.
Yep.
So we'll tackle them. Obviously, we're not going to come over and pack up the stuff. However, we do have resources, different services that can help with stuff, process strategies. The stuff is a thing.
Can I add to that?
Yes.
Rate, stuff, and stairs?
Oh, yes. Perfect. With stuff, sometimes the way that we organize a transaction, we can help them secure the one-level living home, the villa first, allow them to have a process to move the stuff they want, to eliminate the stuff they don't want, because sometimes it's hard to know what to bring to the new home. So there are ways we can achieve acquiring the new home first to accommodate the movement of stuff, okay?
Yep.
Okay. Now, interest rate, that has been a really common thing. If anybody owned a home during 2020, 2021, and early 2022, most Americans refinanced to interest rates that were at the lowest level in American history. Those rates were stimulated by our government, putting money into mortgage-backed securities, bonds, other things that caused those rates to be so low. Probably will never see those rates again.
I doubt.
Probably. But there's still, it still feels like, gosh, is it foolish to leave this interest rate, even though the home no longer meets my needs? Is that fair?
Yep.
Okay. So when people come to me, obviously there's a lifestyle question, but we still have an asset question. So we can't forget that real estate is a commodity, an asset. And so we have to consider the math around that investment. In addition, the interest rate on a primary residence, the interest paid rather on a primary residence is tax deductible. So now we have some tax advantages, benefits, strategy that we have to consider. And so beyond that, it, of course, is lifestyle. Mm-hmm. And that is difficult to quantify or put math around. So let's talk about this. In some cases, people may want to, get to that new home, and they might be leaving a 3% rate, going to a 6% rate. Well, good news, 100% of the interest you pay is tax deductible. So it's not a complete loss. In addition to that, many times people are buying a home that may appreciate at a different amount if it's a higher price property. So if you're leaving a home that's worth $300,000 and it's going to appreciate at 4% per year, it's $12,000 a year, and you're going to a home that's $600,000 appreciating at 4% per year. Well, that's $24,000 a year. So we have to consider the multiple.
Yep.
And then we'll have some clients that, hey, they love the performance of the asset, the commodity, and they may want to just amplify their owning of other real estate. So buy the home that they want and keep the home that no longer fits their needs with that low interest rate in it, because never, ever, never would you get an investment property at a 3% interest rate. So
True.
This could become a different animal where someone could build cash flow, passive income, and use that investment piece of real estate for real as an investment.
Mm-hmm.
So all of these things we can unpack together just depending on the circumstance. Sorry, I didn't know if I answered your question, but tell me where you'd like to go from here.
Well, I think the biggest key is kind of that the all of the information that's out there about reverse mortgages. So let's say one of the things I've heard from a few people was, what if the money runs out? What if I outlive my mortgage? How does that happen?
So reverse mortgages, this is a little bit of a different animal, and a reverse mortgage is a loan type available to those people that are 62 years of age and older. So commonly, this is the group that's looking for one level living, etc. And I do love a reverse mortgage for the right circumstance. Here's how they work. Number one, someone could buy a new home or refinance their current home from their traditional forward mortgage, where you're paying principal and interest payments every single month. Instead, we would be using what's called a reverse mortgage, where no payments are being made. No principal payments are being made. The interest is still being charged, but the interest is being added on to the principal balance of the loan every month. Okay, so we set the stage. It is a different type of loan product, but here's the real value or benefit of it. For real, it's a lifestyle loan. Many times when people move into retirement, the income goes into a fixed income state, Social Security, pension, maybe money from investments. And what we've seen the last several years, Brian, is we've also experienced inflation. So the cost of living has been increasing faster than the increase in the fixed income.
Correct.
Okay, so then over time, that may cause a problem with cash flow and lifestyle. So oftentimes we'll help someone buy their new home, their villa, their no staircase home. They may choose to use a reverse mortgage, and the benefit is they're not making a house payment. More cash flow stays in their daily living, really to create memories, to build experiences with family members, maybe to bless family members, and enjoy life while they still own their home. And I mentioned that interest continues to build each month, added to that principal balance. Well, at no time ever could the value be underwater on a reverse mortgage. At no time ever. This was a law put into place by Congress that protects these homeowners. If something happened that was tragic, like 2008, 2009, where housing values plummeted due to the housing bubble, well, that was a time where real estate values had diminished pretty significantly for a couple of years. And that's when Congress acted and said if somebody took a reverse mortgage, they could never be upside down on their home. If they sold their home for a certain amount and for some reason that loan balance was higher, well, automatic, it's written down without any negative consequence in the credit.
Wow.
that is not the case with a forward mortgage. With a forward mortgage, if you owe more than the home is worth, you're upside down, and
Truly
there's
stuck.
no solve. There's no solve by law for that. But on a reverse mortgage, the solve is there's a law that would protect that homeowner. Yeah.
So what about, like, one of the other things I've heard, and this is from within the industry, is that the front end costs are higher than your typical mortgage. Is that true, or?
Great question. Closing costs on a reverse mortgage are similar to a front end mortgage. However, just like on an FHA loan or most VA loans and USDA loans, a reverse mortgage is also a government insured loan. And so there is upfront mortgage insurance premium and monthly mortgage insurance premium that gets, added to the loan balance or the payment, just like an FHA loan. Now, what's mortgage insurance? Mortgage insurance is insurance that the borrower pays for to protect the bank's interest. If there was ever a claim or it went upside down, they're using that insurance premium to prevent from foreclosure. So all government loans have mortgage insurance premium. Now, why is this a standout for reverse mortgage? Well, here's the difference. Usually, if somebody is buying a home at this stage in life into retirement, they've accumulated enough wealth that they're going to put a large down payment on the home. Many times it's over 20% down payment. Mm-hmm. Well, we know with a conventional loan, if there's a 20% down payment, no mortgage insurance premium.
Yep.
So the difference on a reverse mortgage, even if there's a 20% equity position or more, there's still that upfront mortgage insurance premium. So that's the difference.
Okay. But you're receiving payments instead of making payments. So,
well, in some cases, so there are different reverse mortgage programs.
Oh.
There's a variety of reverse mortgage programs or products, we call them. So like think, shoes, mortgages, and then you have Nike, and then we have government loans, and then we have Nike running shoes, reverse mortgages, and then inside of running shoes there's types. So same thing. Okay. So now we have reverse mortgage, and then inside there's products. For example, there's just a fixed mortgage rate, and whatever you take your loan amount at, it just stays right there. The interest builds each month over time. That's one product. Another product is you could open it like a line of credit.
Okay.
So if someone comes in and they have a lot of equity, they could actually draw that equity monthly coming into their checking account each month as a payment from their mortgage to their checking account. Now, as they're drawing that equity, of course, the principal balance is increasing. So let's say they take $600 a month in equity as a payment to checking. Well, the principal balance would increase by $600 a month.
Okay. Mm-hmm. And that's what I'm more familiar with, is that style of mortgage. So what is there a certain point where they, if they're let's say they're in their forever one level home, and they're drawing $600 a month to help, create that lifestyle and the memories like you're talking about. Is there a certain point where they need to sell, or, they run out of equity, so to speak?
Great question. There is a certain point where they would stop drawing. And so there's going to be, no matter what, there's going to be a required equity position, getting into the loan, or if it's like a line of credit, where that will stop at how much money you can take out until it stops. So how do we define what the equity position is? Mm-hmm. Well, it depends on the age of the youngest borrower, the interest rate or loan type that they're using would define the maximum loan to value, or the opposite is the equity position of that.
Sure.
Now, I'm helping a family, client right now. She's doing a fixed rate. So we're establishing just a base loan amount. We're not drawing on it every month. The interest will grow each month. So she doesn't plan on ever taking money from her equity. But she just doesn't want to make the monthly payment to her mortgage any longer. So according to her, she wants to spoil her grandchildren rotten and create memories they'll never forget. She wants to be infamous, forever remembered, legacy grandma. And how cool is that?
That's how you do it.
Yeah, this is how they do it, how she's going to do it. And in her circumstance, her adult children said, "Mom, spend your money. We don't want it and we don't need it." In addition, when I asked this client, hey, at some point, if you ever had to move into assisted living, nursing care, memory care, some other type of expensive, medical care lifestyle, are you planning to fund that entire amount? And in her position, the equity is like $150,000. Well, she says, gosh, at at 10,000 or more per month, depending on care level, I could only pay for my long-term care for less than a year, and then I'd have to go on to the state. And she said, I don't care about that phase of my life. I want the money to make my memories now. My kids don't need it. So it wasn't important to her to be self-reliant on her own income into memory care or nursing care later, knowing that it's possible she could go on to the state anyways. Okay,
cool.
Little sidebar. But let's say she does move into that care position. She moves out of her home and into an assisted living facility. At that time, now the mortgage will have a clause that says that it becomes due. Yep. There's a period of time, of course, in case they're in nursing care and come back, and that's all accommodated for. But if they're permanently moving into long-term care, now the adult children or the appointed executors would work to sell that property. And just like a traditional sale, so when you go to sell the property for highest and best and over list price, like normal, how Brian does it, then the loan balance gets paid off. The real estate commission, seller fees are paid like normal. And then any additional profit would go towards that person's checking account. Mm-hmm. Now, what if mom moves to heaven? Instead of assisted care, moves right to heaven and leaves this earth. Well, the same process would happen. The heirs or the appointed trustees or whatever the authority is would work with Brian to prepare and sell that home. When the home sells, the mortgage balance or any other liens are paid like normal. Any profit would go into the estate for the family to deal with. It's a normal transaction on the sale.
Mm-hmm. Mm-hmm. Interesting. Now, I've seen people buy new construction using a reverse mortgage.
Yes.
And I guess I was assuming, because they were my buyer, I was assuming I didn't sell their home, unfortunately, but I'm assuming they probably came in with a lot of equity.
Sure. And again, depends on age, but boy, let's say someone is, 70 some years old. They're probably going to have a 40% equity position, give or take. It's not a black and white mathematical equation. It depends on the age of the youngest borrower, the interest rate, the program type will determine the equity position. But usually there's a strong equity position going in because we always want to maintain equity. That really is the goal. As the balance of the loan inches up, each month or year over year, presumably values are going to continue to trend upwards and inch up, keeping an equity position. And the hope is at no time would that reverse. That's really how the loan is designed. Only in some catastrophic event like 2008, where there was a housing bubble, did we see that. But again, in reverse mortgage land, the borrower could never owe more than the balance of the home. Completely protected. This was an act of Congress, and it's the only loan that allows that.
That's huge.
Yeah.
So, I mean, if someone were to do this, I mean, they're protected. They won't go upside down. And then it's just really, do they want to try and gain some income from the program, or just not make payments anymore and use that equity to create the memory.
Yeah, support. It's really a lifestyle loan. It really is a lifestyle loan.
I think that's really cool.
It helps people have control and use. So I'm going to say this differently. We work so hard all of our life spending time away from our families to build and build and build and acquire the safety and security that shows up through assets, real estate, etc.
Yeah.
And here's what's special about real estate. If someone has lived in their primary residence for 2 of the last 5 years, you can earn $250,000 per owner in tax-free income. It's like the last untaxed thing in America, except for groceries.
Yeah.
And so, understanding that, the tax benefits, the strategy, some of that leverage, this is where the wealthy play, when they understand these moving parts. Well, let's say they maybe they're selling their free and clear home, and instead of just buying the next home free and clear and using up the majority of the liquid assets, they may put a down payment, put a reverse mortgage, never make a payment, but take a large chunk of money to live off of. Take the family to Disneyland, whatever floats your boat. And now that becomes a lifestyle choice. Maybe you're using that money to bless your children and grandchildren on this side of heaven as the inheritance. We're seeing more of that. Many times, grandmas and grandpas want to see their children and grandchildren have the bounty of their inheritance where they can enjoy that. Buying a home, for example. Maybe you're helping a grandchild buy a home on the inheritance paid forward and not after moving to heaven. So there's some really cool things that can come alongside this as a result of this lifestyle loan.
Yeah. Awesome. Well, there you have it from the reverse mortgage master, Molly Nadeau. Neighborhood Loans, we'll put the information down in the description for contact. And if you have further questions, feel free to reach out to either of us. I'm Brian Ingle with the Chris Fritsch team at eXp Realty. And you're Molly
Thank you.
Nadeau with Neighborhood Loans.
Cheers.